We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelming on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Trent Norris, fund manager at Sterling Capital. How are you today, Trent?
I'm doing great, Tom. How are you doing?
Excellent. Great to have you. And I have to ask, do you have any relation to Chuck Norris, considering you are in the Lone Star State?
Well, sadly, no. I do have a little bit of a story. I did do karate back in the 80s. So just to let you know, that name was, as you can imagine, pretty popular.
But you didn't practice with jeans on?
No. And I never really got the roundhouse kick down.
Awesome, Trent. So why don't we start by asking what got you into the metals and the mining equities?
Okay, well, so I would say as far as the metals, I wasn't in the space during the last bull market, but I did watch silver run in its euphoric, way that it does to close to $50 an ounce back in 2011. And so I told myself, hey, when these things start to move, and of course I heard about it right when it was moving from probably $35 to $50. But I told myself, hey, when this stuff moves, I want to be in it the next time. And so that's kind of my first kind of introduction into the metals. And then I started to really buy physical silver for the first time in 2015, because I was watching it just fall, basically to the price of where I could get in with premiums for an average cost of, I remember back then I was buying $15, $16.50 with premiums. And so I put a lot of, my capital and money that I was saving into physical silver, because I just couldn't believe how inexpensive it was. And then I did a little research into what the mining costs were, right, for primary silver producers. And I realized, wow, it's like over the price. Their costs are over the price that I can buy this stuff for retail. And I just thought, wow, what an amazing asymmetric, buying opportunity this is. And so that's when I first kind of started to buy. And at that time, and everyone remembers, I watched First Majestic Silver right in 2015, I think, go from around $3 a share to $18 in a matter of, I think, a little over 6 months. And I was hooked. And then I said, okay, this space can get really exciting. And so I want to learn more about it. And at that moment, I just kind of went all in as far as learning about this space. And then I started to, get into the space myself. And then as I was studying and learning it, I realized that basically none of my friends, none of the people that I knew, even guys with a lot of wealth, they didn't have any clue that this space existed. And so I had it in the back of my mind that one day that I'd like to start my own fund and help people in this space, because it is very difficult.
Yeah, and as you were telling me earlier, you said that you realized there was a real lack of understanding of the precious metals, central banks, and monetary and fiscal policies and asset inflation, right?
Right. So my kind of background, right? So I was a business owner, and I had a retail business, a sporting shop, as a tennis shop in Austin, Texas. Started it from scratch, and I put it right in a very wealthy suburb in Westlake near Austin, and is in Austin, and it's just right outside. And what I came to realize is a lot of people that I did business with, these really smart people, a lot in high tech, a lot of oil and gas, construction, but very, very successful business people. But one thing, when I talked about honest money, when I talked about the Fed, when I talked about macroeconomics, I think at the time, 2017, I think that was the first I'd heard about the negative interest rates worldwide. And, it's how much negative yielding debt there was out there. It's like $17 trillion. It's amazing. And I was saying, wow, this is going to have a huge impact on, our entire world. And so I talked to people about this, and they were just fascinated listening to me about what I was learning. And I just realized that not too many people even go down this kind of rabbit hole and learn about these things.
So why is right now one of the best buying opportunities that you've seen over the past 5 years?
I would say, as far as where we are in the cycle. So I see the mining stocks, I see gold and silver. I look at them as cycles. So gold entered its bull market. It confirmed its bull market in 2019 when we kept watching it hit about 1350, and then it went into a bull market in June of 2019. And silver entered a bull market, its own bull market, after the March 2020 low. It entered its bull market, I believe, in the summer of 2020. So typically these bull markets last for about a decade, and we're just at the very beginning of this one. And so right now, the mining shares, the mining equities, gold and silver stocks are relatively inexpensive compared to where the price of gold is even trading today and the price of silver is trading.
So you had sent me a couple of slides from your presentation there, the Sterling Capital presentation, and in it you're really making the comparison to after the financial crisis in 2008 to basically the monetary stage now, where we have a very similar interest rate environment and massive printing ongoing, which in 2011 led gold to new highs only 3 years after the crisis, right?
Correct. And so, yeah, we're in a similar spot now where we kind of know what the playbook is and it's unfolding. And now it's all about patience and waiting and getting in to make sure we're in correct positions to take advantage of that. Because we know the playbook, we know what's coming, and it's just going to be more of what we've seen. And it's an opportunity.
So I think after speaking to you a bit more here, something that has come up several times is patience. And I want you to talk a little bit more about that and how you think about being patient and maybe having capital ready to deploy when you see a buying opportunity present itself.
Sure. Well, one thing that I've learned in the last few years of being basically all in this space for myself, and now having a fund where I manage other people's money, is there are buying opportunities that are coming. And especially at the beginning of a bull market, we will get these opportunities from time to time. And there's a lot of volatility in the space. So I see it as you want some cash on hand to be able to deploy capital in those moments where everyone is just kind of selling, right? They're selling into the weakness, and that's what you want to buy. Is you want to buy the weakness. And so having cash available is really important. The patience part of it is a huge part, especially in the resource space. Patience will pay. And my favorite movie, for an example, is The Big Short. And in The Big Short, kind of part of the movie was focused on Michael Burry and just how patient he was, waiting for that trade, right, to take place. Even in the worst moments where the banks were, defaulting, right, and the bonds, they were still going up in value. They weren't going down, and it was just one of those moments where it's like, wow, this is horrible. This trade is not working out. But it's in those moments that it's the light, right? It's the what is it? The dawn before the light of day or whatnot. But anyway,
it's always darkest before the dawn.
That one, thank you. Yeah. Anyways, yeah.
So why is the focus of Sterling Capital to be heavily weighted in the best silver stocks?
So I personally, I named it Sterling Capital, and that's kind of because I wanted to focus on silver. So I personally like silver, and we know it's been a monetary metal in history. It's a precious metal, but it's also an industrial metal. So you kind of get both. And I like the upside potential of silver in a bull market. Now, of course, that comes with more volatility. So currently how I have the portfolio allocated is silver right now, silver stocks, gold stocks, and then copper stocks. And so that's kind of how I have my allocation, mostly in that vein.
So how do you basically, let's say, structure your portfolio? You basically separated it into two parts. Is that right?
You have to remind me, what two parts?
Your buy list and your wish list.
Oh, absolutely. Right. So yeah, got you. Exactly. Okay. So that's what I keep that's my list of stocks to buy. And so what I kind of do and what works for me is, so I have what I call a Fab 5 list. And the Fab 5 list is the 5 stocks that if a March 2020 event were to happen again, I would want to buy. And especially if they were to take a 50% or more plunge, those are the companies that I think would be literally layups at those type of valuations. And so I like to keep it simple, because having too many of them, because I was fully invested during March 2020, and I lived that. And to watch the portfolio and these stocks get literally hammered for a few weeks, and then we all know what happened, right? Come right back. But to be prepared and to have a plan of action, I think is so important. So I call it my Fab 5 list. Those are the 5 stocks that if, the stuff hit the fan, this is what I would want to buy. And then I have another list, just like every good investor has their list of their buy list that's ready to go. And right now I have about a dozen different equities that I'm looking at that are within maybe 10 or 15% of my price. Some are actually at my target now, and I always keep that list.
So can you explain to us, Trent, what is some of the framework, let's say, that you of how you structure each of those lists?
Sure. So my Fab 5 lists are stocks that I look at that I, through research that I currently hold, but ones that I want to add much more greater positions to. I want to add a lot more shares of those particular companies. And then the other list is those are ones that I may hold some of those stocks or may not, but those are ones I want to get into that, I kind of look at them based on where they are relative to like their 52-week lows, or what kind of value I see in them, today. And so that's kind of what I'm looking for. I'm looking literally in this entire resource space. I'm looking for that asymmetric bet.
So do you want to give us a couple examples of, let's say, something from your Fab 5 list as an example of what kind of companies make that list, let's say?
Yeah, absolutely. I don't mind doing that. So for the Fab 5 list, I'll give you one. A lot of people have it. A lot of people know it. It's Discovery Silver. And the reason why that's in my Fab 5 list is that deposit is rare in that it's a bulk tonnage silver deposit, that it is located in Mexico, but they have millions of ounces of silver in the ground. So I know if that stock were to sell off, say 50%, that is one that I would want to go in, because the silver's in the ground. It's rare. Eric Sprott is a large shareholder in that particular company, and it's just an exciting silver play. And so that's on the Fab 5 list. And then another pick right now that I'm looking at in just my regular watch list, I really like Wallbridge Mining. The reason is it's a tier 1 jurisdiction in Quebec. They're coming out with a resource estimate in Q3, so this quarter, and they have a lot of gold. I think one of the things about the stock is they're not seeing on the drilling the widths that they were, and I think that's part of the reason that the stock has been selling off. But let's not kid ourselves. There's a lot of gold there, and that's a stock, and I especially like it where it's priced right now. I see that as an asymmetric buy.
So how do you, let's say, take into consideration jurisdiction? Some people are comfortable with Mexico, some aren't. So how do you look at different jurisdictions, and how do you weight them?
Being a silver equities investor, kind of have to be somewhat in Mexico, right? Because the majority of that, they're the largest, silver mining jurisdiction. And so, yeah, I'm okay with Mexico. But it's all about the price I'm paying, right? So that's really what it comes down to. So something like Discovery Silver with the ounces and that management team, I'm okay with that particular company in Mexico. Absolutely.
So
and then, yeah, go ahead.
Go ahead, Trent.
I was going to say, and then with Quebec and Canada, to me, that's one of the safest jurisdictions. So for Wallbridge Mining, I just put that up as at the top of the list.
Mm-hmm. So how do you determine what's a fair share price, what that price should be, where you want to get into it at? You mentioned that you can be patient. You want that stock to come to you. So how do you determine what that entry point is for you?
Well, it depends. So for the Fab 5 list, I think all those stocks that the 5 stocks that I have on my list, if there was, say, some type of, waterfall decline tomorrow of 50% or more, all those stocks I would buy. Now, right now, I think they're fairly valued. My buy list, in my opinion, is much more discounted today. And that's why they're on the list, because I see the value in those. So I want to buy those stocks when they're cheap. It's all about, as we know, buying low and selling high. And so I look at 52-week lows, where is it? So like Wallbridge is pretty close to its 52-week low, say today, and it's not far off from its March 2020 lows. So to me, I look at that as, wow, that's a floor there. So that's one way I look at them, is just basically, the technical analysis of where it's trading, right? And then, the fundamental analysis of what's going on in the project, and is this something that I could see being taken over? Is it something I can see, going up with obviously a higher gold price? Does it even need a higher gold price? Well, I'm not so sure it even needs a higher gold price. I think the gold price at 1,800 with Wallbridge here at this price is fantastic.
So why don't you give us your nightclub analogy, Trent? You told it to me earlier, and I think it's a good way of explaining to just to convey a different way of thinking about what you're trying to achieve, let's say.
Sure. The nightclub analogy is, well, we've all been to nightclubs, and I haven't been since 2000 and, whenever back in the day. I've been happily married since 2008. But the nightclub analogy and why it's kind of fun is it gives an example of how to buy something cheap, and then how to actually take profit from that and walk away with your profits. So let's say, Tom, you and me want to go to a nightclub, and we're back in our single days. Well, let's say we know that this particular nightclub, and we know from history that at, say, 11 o'clock, this nightclub goes off, and this is where we want to be. So what do? Well, it could, this particular nightclub, maybe it starts hopping at 10, right? So we get there at 9:30, you and me, we have a drink at the bar, and then getting close to, 10, before 11 o'clock, we get to the middle of the dance floor. And you know what? It happens. Just like we looked from the example of, hey, this place goes crazy at 11 o'clock. We get to the middle of the dance floor, and then everyone just comes in, right? And all the nice looking ladies come in, and the place is just amazing. And that's like the euphoric time, right? When you're in an investment and everything's just clicking. Okay. And then, we're doing our thing, and we're enjoying it. And, we look around, and we maybe notice that, okay, the vibe, it's kind of slowing down a little bit, and we want to exit that nightclub 1 o'clock, at some time, and move out and just enjoy that memory. And then you have other people in the nightclub, right? They're just going to keep wanting that same vibe that they got at 11 o'clock, and it just won't be there. And by 2 a.m., it's just going to be a few drunk guys who are there going, oh, this nightclub's awesome. This party, let's keep this going. It's been long gone. The party's long gone, right? The cleaners are going to be sweeping them off the floor the next morning. And that's kind of how I like to talk to young people, especially who maybe have made, certain investments and even other types of assets like cryptos or anything like that. You want to get in early, right? You want to be right, and you want to sit tight, and then you want to figure out where you're going to make your exit. And so I think that's just kind of an analogy that kind of makes sense to a lot of people.
Yeah. Like you say, get in right, be patient, and then don't become too attached. Plan that exit strategy, right?
Absolutely.
So what is your exit strategy then, Trent? Where do you try and or do you try and pick particular targets? Is it more a timing thing, a feel when the market is starting to roll over? Where is that point to you?
Okay, well, big picture, my exit strategy for the space, kind of just based on history, these cycles go for about 10 years. So I kind of have a date, and this is just based on the last two cycles of about, later in the 2020s, I think could be possible that the end of the bull market, happens. So I have a date of 2028. It could be 2025. It could go a lot longer. But that's kind of how I look at as what I think we have left if you're asking in the rest of this bull market. And then specifically for individual names and stocks, honestly, if the actual name and the stock is performing well and doing well, I don't like to cut winners. Okay. Now if they go parabolic, there's nothing wrong with trimming a stock. I don't have hard and fast rules with that because that's just not my personal style of if a stock say doubles, I don't take 50% off.
Mm-hmm. So as you said, bigger picture, what are some of your favorite charts that really instruct your whole thesis here?
Right. Okay. Yeah, that's a great question. I really use the Dow Gold ratio, and that's actually a chart that really actually changed my life because I started to view the markets in the lens of, okay, when do you buy regular general stocks and when do you get into gold and gold plays and precious metals? And it just shows the cyclicality, especially the 100-year chart of those different cycles. And, so for me, one of the things I'm going to look at in my own plan is where we get in that Dow to gold ratio, where I will start to take profits for good out of the resource space.
So is that how you came up with your ultimate price targets for gold and silver, Trent?
I did. So they're a little interesting how I came up with it, but I took the two previous cycles. So 1970 to about 1980 and 2000 to 2011, roughly. Well, if you take the average gain in gold, and I realize the circumstances were different in the 70s, that gold was fixed at $35 and it ran to, 850-ish. So, but if you take those two cycles and you combine the average of those, you get a 15x on gold and a 24x on silver. And that's at the peak of where the Dow gold ratio started. So, where gold started to outperform the Dow, if that makes sense. So that happened recently in September of 2018. And if I'm correct, the price of gold was around $1,200 and the price of silver was around $14. So if we put those multipliers on there, it gets pretty large numbers, very large numbers at a target date of around that 2028 based on history.
Based on the cycle, mm-hmm. Previous cycles, right?
Previous cycle. I mean, it puts gold up around 18,000 and it puts silver at 336. And, it certainly sounds extreme, but based on the two cycles in a euphoric, complete melt up in the metals, it is possible based on history.
And one of your other favorite charts that we have here is the GDX. So how do you look at that and find that instructive as well, Trent?
Right. GDX, GDX.J. I mean, if you take the GDX.J, how I look at that chart is extremely bullish because it really shows so many years of just this sideways grinding that is just building up energy that I look at it and I see it as extremely bullish and I see it as a runway, right? So the longer the base, the higher in space. And I truly believe that that is a very bullish chart
for our sector. And it just shows how much, in my opinion, how much time this bull market could actually last.
So Trent, are there any, let's say, macro considerations that would make you change your thesis on the metals at all?
I would say, what I tell clients is what would change my mind if the Fed was able to start to raise rates consistently and to stop with their stimulus, right? And reduce their balance sheet. I don't see that happening. I think it's the exact opposite. So if that happened, sure, I'd have to reconsider the thesis.
Mm-hmm.
I mean, it's almost laughable thinking about it right now in this moment.
Absolutely. So do you have any views on why silver is still the only commodity that is cheaper now than in the 1980s?
That's kind of a tough one because it's an extreme compared to all the other commodities. How inexpensive it is compared to where it traded then, and I believe it's absolutely the price is manipulated like a lot of markets. It's a difficult one to really understand, but I see it as an opportunity to take advantage of. I think it's something that has been kept down for a reason personally.
So in that way, it makes it more appealing to you that, at some point that has to change, and that makes it more of an asymmetric play for you.
Correct. So how I see it is every time these bull markets conclude, whether it's 1980 or 2011, silver goes euphoric. And so that's kind of what, my thesis is that we're going to eventually see. And it makes sense that would repeat again.
So Trent, how do you think about risk management when entering a position or even, let's say, structuring your portfolio?
Well, so as you know, Tom, these stocks are very volatile. And so for me personally, I don't want to have too many names because then the portfolio just becomes unmanageable. But you do need to have a fair amount of positions so that you do at least hedge out some of those risks. And so what I like to do is I like to enter in positions that I just think are really good value and just be patient in them and wait for more buying opportunities to come. And I just believe that the key in this whole thing is patience. And I truly believe that the sector is not an if thing, it's a win thing. And so as long as I buy for good value, then I think that is the best way to enter these plays.
Excellent, Trent. Is there anything else you'd like to add before we wrap up here?
I can't think of anything right now. Maybe just that it's pretty interesting. We got a real interesting inflation number today, mm-hmm. and it's still considered to be transitory. I'm not personally buying that narrative, but it sure seems like the market is really buying that narrative, and I find it interesting. Maybe just to say to people who are investing in gold and silver stocks, this hasn't been necessarily the easiest time, but I think that our patience will pay off because I don't see this inflation going away. I also think that we're in an interesting time that, stocks have very rich valuations. I think we're in an 11-year bull market in the stock market, right? The bond market, interest rates are extremely low. The bond market is very expensive. And in my area in Austin, Texas, real estate has recently just literally gone vertical. It's absolutely insane. And I tell people, hey, when your personal residence goes vertical,
That's never a good thing in history, right? In just a few months. And so these to me are warning signs. And I think that the reason that gold and silver haven't yet really entered into like a momentum phase is because investors are still focused on what the last 10 years, the last decade looked like, and investing that way.
I want to go back to something that you said there, where the market isn't necessarily reacting, like you said, to the inflation. So don't you think the market reaction should be to start moving the metals and stuff? Or let's say traditionally you would think of that typical market reaction to higher inflation numbers like that be to get into safer hedges against inflation?
I think it's coming, but I think right now what's happening is, say, the algos, the traders, they are literally programmed to, if we get a high inflation print, is to then sell the metals initially or not buy into them just because that they believe that the Fed is actually going to tighten. And I think at this point, I just hear the Fed doing a lot of talking. So to me, I see it as an opportunity to get even better positioned into this space, because to me, it's just the daily noise.
Mm-hmm. Excellent, Trent. Of course, you have a very good Twitter feed as well, at Trent Norris 13. Anywhere else you want to add?
Sure. People can reach me at an email as well. That's Trent Norris 24 at gmail.com.
Perfect. Thanks so much for your time today, Trent. Really appreciate it.
All right. Thanks, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.